Do you see rising rates would have a significant impact on REITs' ability to pay a distribution to unit holders?
We will definitely see branded interest costs for Asia REITs to go up in the next few years, as we have seen base rates as well as swap rates have increased in 2022 and are still expected to increase further into 2023. However, it will not be an immediate hit or step up in financing costs for the REITs in a single year, but it will be staggered over a few years, as is because fixed rates hedges roll off or bank loans or bonds mature and get repriced with new issuances over the next few years. Broadly speaking, Asia REITs would have about 60 to 70% of their borrowings already fixed, with some REITs running at higher or lower levels. We will be mindful of those REITs that are running at low hedge ratios. Based on the sensitivity of interest costs on the Asia REITs, or Singapore REITs in particular, it is estimated that every 100 basis point increase in interest costs will cut dividends by less than 4%. A continued recovery in rental cash flows as well as net property income could potentially offset part of this interest cost increase. So at this point in time, I wouldn't say investors should be very concerned of a material step down in the dividends distributions that they can secure from the Asia REITs.
As most of the world has reopened and with inflation expected to continue to rise, what are the impacts to retail REITs and hospitality REITs, and what is the impact to the consumers?
Broadly speaking, if you look at empirical evidence as past experience, inflation has generally been positive for real estate assets and for landlords in retail and hospitality areas, as they are able to price up their rooms or their rentals for retail. The breaking point or the question would be then whether that higher inflation cost would erode consumer confidence badly or lead to a big cut in spending power. This is particularly true for the retail space and something which we watch very closely. But within retail, we have seen that necessity malls to remain resilient and have seen this through past cycles of slowdown. In terms of inflation impact on consumers, so far, consumption has held up well across Asia on the reopening tailwinds and the momentum of a job market. Job market is strong and wages have seen healthy growth, and we have seen supportive government supports for consumption for lower income group like Hong Kong and Singapore. Necessity malls in Hong Kong and Singapore remain an area we like given their resilience through economic cycles and the ability to recover further in terms of rental rates. Hospitality REITs also stand out on strong pent-up demand for travel, and strong recovery in cash flows will underpin their asset values.